Well, now we get to finally put some money to work here into a strategy that you might actually choose to make part of your financial life. And we're going to do it in a way that I know you will understand these tables and how they would work, so that while we're only going to look at 2 of the 9 tables today, you'll see how to use them, and hopefully they will be helpful in you making a serious decision about what equity strategy you're going to use, and how much money you're going to invest. So let's first, ever so quickly, go through the numbers that brought us here today. The first segment was all about equities. And what I focused on, and I'm not going to go over the whole thing, was the reality that the S&P 500 over the last 96 years compounded at 10%. That turned $100 into $950,000. Large cap value that compounded at 11 turned that into 2.3 million. Small cap blend, small companies, some growth, some value, 11.9. That turned that $100 into almost 4.9 million. And finally, small cap value at 13.2% grew to almost $15 million. So this is the case for equities. By the way, I'm not going to put you through the fixed income page, but I will just tell you that on the fixed income page, that $100 grows to somewhere between $2,000 and $12,000, depending on what fixed income asset class that you select. So we're really rooting for you to put equities, particularly if you're very young, all equities in your 401k or your Roth IRA. And then we showed you we wanted to take a step here in the second segment, take a step to figure out what equity asset classes you could use in your portfolio. Not everything goes back to 1928, but we took it back to 1970, and we looked at 10 different equity asset classes, all approved in essence by the academic community, so that they have said that the S&P 500 and large cap value and small cap blend and REITs. And then over here in the international section, we've got large cap blend, and we've got large cap value and small cap blend and small cap value and emerging markets as a separate equity asset class. So, and then there's the emerging market, which is the last of the 10 equity asset classes. And the purpose of this presentation was to show you how little tiny percentages, 10% of the portfolio being added to a 90% of the S&P 500 added an extra $2 million to the return over this 54-year period. Anyway, we went from there then to the next table H2A. Now we're putting together the portfolios. We're combining, we have the S&P 500, but we show it compared to the ultimate buy and hold, compared to the worldwide 4 fund, compared to the U.S. 4 fund, the worldwide all value, the U.S. all value, the worldwide all small cap value, and the U.S. small cap value, and finally the combination of the S&P 500 and the small cap value. And we showed the growth of $10,000 investment. And as you can see, there's a broad range from 2.4 million with the S&P 500 to the highest return was right around 10 million to $11 million. So it did make a difference how you combined and which of these asset classes you put in your portfolio. And then we had all the information that showed the decade performance and the up years and the down years. So what we're doing here is we're getting then to the fine-tuning tables, because now we're going to throw in the fixed income, the bonds. So we see the S&P 500 here, annual return. We see its compound rate of return over this period of 54 years is 10.7. But then we look at the returns by adding some amount of fixed income. And by the time we get down to a 50-50 strategy, half in stocks and half in bonds, instead of 10.7, it's 9. If we got down to 20% in bonds, 80% in bonds and 20% in the equities, we get down to a 7.7. And finally, if we were all in bonds, the compound rate of return was 6.7. So you could decide how much risk you're willing to take, and that is where we try to help you. There is showing the worst 12 months, the worst 36, 60 months, the worst drawdown. So we're trying to show you the good times and the bad times. And then there, of course, you have in red the losing years that you suffered with these different combinations. So now you have the returns. And by the way, you also have the returns in another fine-tuning table that goes back to 1970, but this time the portfolio is made up half S&P 500 and half small cap value. So you've had all this background on the numbers, but we really don't yet know what happens when you put money into those numbers. So now we finally get to put some money to work and get out of looking at the numbers and look at the numbers that really matter. Now, having said that, we all know we can't buy the past. So what you are about to see is the impact of your theoretical investment on a theoretical past, and to see what the implications are during this period of accumulation, because there are some things that are unique to accumulation that I want you to be sure and understand. Here we have table C1. Notice it says fixed contributions. This means that we're going to put a particular amount, a fixed amount away every year. As a matter of fact, in this particular table, it's done monthly, similarly to what you would experience inside of a 401k plan, or maybe put money monthly into an IRA. But the amount that is contributed each year is going to vary by 3%, because every year, the first year 1,000, the next year 1,030, the next year 1,061. Every year you are putting a little more in, and theoretically we do that, one, as a way for you to have more in retirement than you would otherwise, but two, to respond to the impact of inflation, because you are likely to experience some inflation. The 96-year average is 3%. And so that 3% kind of just makes sense. You do have, because we're using the fine-tuning tables for you to put this money in, you have the choice between being all in equities, 90% in equities, 80, 70, 60, all the way down to having 100% in bonds. So you can look at what the difference in risk is, volatility, and you'll see that, because in the bad times, you're going to see the portfolio that has bonds in it doing better. Not losing as much money would typically be the case. But we want you to see these different levels of risk. Obviously, if you're an early investor in your 20s or in your 30s, we're hoping that you'll be all equities for 20 to 30 years. But maybe that's a decision for another day for you, but it's an important decision, because remember, the equities, that's where the real growth was. So here you go. You're starting to put away $1,000 a year. I want you to notice at the end of the first year, you only had made $22. $1,022 is what you have in your account at the end of the first year. That means you put in $83.33, and the market, and that totals after 12 months about 1,000, and the market gave you very little. You're going to see years later on where you may make $50,000, even $100,000 in a year. We'll try to pick some of those out so you'll know I'm not just blowing smoke here, that it really does happen. And that's because you started with a small amount. If there's a partnership between you and Mr. or Mrs. Market, Benjamin Graham called the stock market Mr. Market, but let's call it Mrs. and Mr. Market. The end result is the market did very little. You were the driver. You were the one that caused there to be more than $1,000. And you may not remember this, but during this period of time from 1970 to 1979, the S&P 500 compounded at around 5% a year. It was not a good period because it had a difficult time in 73 and 74. But notice you actually only show one losing year. The first year, you end up with 1,022, then 2,275, then 3,873, then 3,000, 4,308. And then for the first time, you actually end up with a losing year, including what happened in the market and what you put in. But then it comes right back and you're at 7,000, and then you're at 10, and then you're at 10.5 and 12.5 and 16.2. Only 1 year did you lose money, but understand that a lot of that is because you are putting money into that pool. So at the end of that 10 years, I've got that right here, you put in $11,465. And you made $404,780. You again were driving the truck here. You're causing this to go up for most of what you had at the end of that 10 years. If we just dash over for a second to the two fund strategy, remember that's half S&P 500, half small cap value. You have a lot more at the end of the first 10 years. Instead of having 16,000, you have over 23,000. And of course, that then gives you a new base for the next decade. So as you start out the second decade, you, instead of having 16,245, you have 23,539. And that extra money is going to compound for many decades to come. And the more that the combination of the small cap value and the S&P 500, the better they do, the more money there is there to compound. And money is compounding on compounding on compounding. So if we went to the next decade and going back, if we can here, to the S&P 500, you start with 16,245, you end with almost $120,000. And by that time, you had invested 26,873. Now you're cooking. Now you had a great decade. As a matter of fact, in every year, the amount of money you have in the portfolio is worth more than the previous year. It was a great decade for equities. By the way, the 1990s were another great decade. We never know when this is going to happen. Nobody could have predicted. You're going to hear, if you're a young investor, you're going to, for the next 50, 60, 70 years, you're going to hear people predicting what's coming next. They have no idea. Well, yes, they have an idea, and they base it on a certain set of assumptions and beliefs and a whole bunch of biases. But notice, Notice that now, you having invested 26,873, you've got a real return. And now you're certainly starting, when you have a profitable year, to make more than what you're putting in. But let's go over and take a look at the two-fund strategy. Instead of having 120,000, we've got almost 171,000. Exactly the same amount of money put in. But because you started the decade with more, and you made more with that combination than you did with the S&P 500, you're way ahead. In fact, you're about $50,000 ahead. Now there's $50,000 that is going to be there to compound for you during all of your years of accumulation and your years of retirement. It's not magic, but it is wonderful the way it works. And now you're 20 years into this process, and I think you've got it. I think, by the way, I think it's important that combination of S&P 500 and small cap value is working there for you, because some years it's going to be the S&P 500, some years it's going to be small cap value. Yes, you would have made more money if you had all your money in small cap value. But it also, when it disappoints, could disappoint by a lot more. And what we want, what we wish for you, is a strategy that you can stay the course. I don't mean you have to be all equity for the rest of your life. But I do think that once you get accustomed to how these things work, it's a piece of cake. There's nothing complex here. This would mean you had two mutual funds, the same two mutual funds for 20 years. And every year you put money in one or both of them. By the way, this study assumes that you rebalance once a year, so they start the next year with the same amount. You don't have to do that. It could be you'd be richer if you didn't rebalance, because the small cap value portion would continue to grow faster. But this is the assumption. Rebalance once a year. So now we're coming in to the third decade of this analysis, starting with 171,000. Well, let me go back. Let's go back to the S&P 500, starting with 120,000. By the end of the next decade, you were up to 699,000. There was not 1 year that you had less than the previous year. And in between, I told you about 100,000. How about between 445,000 in 96 and 575,000 in 90? That was 97, and then in 98, 975. I mean, you've got 3-4 years in a row that you did better. Well, I guess maybe that was by 100,000, 3 years in a row, starting with 96. But you had started, you've got almost 5 times as much money. I'm sorry, almost 6. Okay. And it happened in such a short period of time. And by the way, the amount of money you put in is peanuts. But this is the discipline. Get a discipline and stick with it. I'm also hoping that you'll be working for a company where they match part of what you make. Aha, it's in there too. And that would even make the pot bigger. Now, let's remember this. Let's call it $700,000 here at the end of 1999. And in the two-fund strategy, 871. You've got 171 approximately $1,000 more now to work for you for the rest of your life. And you can see every one of those bits of money that continue to grow on each other blossom. And of course, here you can see again years that had made over 100, but actually, interestingly enough, not as productive in this particular decade, because the S&P 500 did better than the combination during that decade. So then we hit a problem. And this is the reason I believe so in having a diversified group of equity asset classes. I don't want you to be mostly large cap growth. When large cap growth, and that's even though the S&P 500 is both growth and value, the big holdings, the largest part of that fund is going to be represented by the higher growth companies because it's a cap weighted portfolio. And when those things fail, they can fail big time. And during the 2000 through 2009, they did. But don't forget, the previous decade, they had a wonderful return. They were cooking in the 80s and the 90s. It was not like it was a shock that they went for a decade where they didn't make any money. In fact, they lost 1% a year. So you started that decade with about 700,000, and you ended, even though you put money in, with 662. And what happened over in the other portfolio, because it had some small cap value in it, and I should say that in a different way. It had some small in it, and it had some value in it, because it could have been small cap blend and it wouldn't have been this powerful. But I want you to notice then, instead of, what did we say, $662,000, we now are looking at $1.3 plus million in that account. And I don't want to be dancing a jig here, but that extra money that you now have, unless you run into a bad market, which can always happen, but you've got a ton of money that is extra money in this account now to be growing for the future. We haven't even retired yet. Well, by this time we might be retired. We worked for 40 years. The fact is, a lot of people coming out of college today or coming out of high school today are going to work until they're 70, particularly if they didn't do the right things with their long-term investments. But I'm not expecting this person, having experienced what they've experienced, to be putting away $1,000 plus 3%. I'm expecting they're going to be happy to put away more money after they see this has worked for decades. And not all the decades were pretty. So now we're through 2009. People who followed our kinds of private management strategies, we looked like we were really smart. It wasn't about that at all. It was because we went into that decade with the idea of a broadly diversified portfolio. But we believed in the broadly diversified portfolio when the S&P 500 was king of the hill too. So there were periods our clients were not all that excited about our work. But because I think they believed we were doing the right thing, they stayed the course, and they were able to capture the better returns that came out of them. By the way, it wasn't that they were knocked the ball out of the park returns. It was they weren't terrible returns. There are times when not being terrible is really good. And so I think the compound rate of return for the all equity strategy was about 7% a year. That was worse. I mean, that was better by far than losing 1% a year with the S&P 500. So now we come into a period, and I'm going to combine the 2010 through 2023. And so let's go back, as we have been, to the S&P 500. You started with about 644,000. And by the time you finish through 2023, you had $3,854,000. I mean, you went up six times over that 14-year period, or 600%. That is an amazing run. And boy, did people feel good. Now they had, for every $1,000 with the 3% adjustment, now if they put away $5,000 to begin with, now they're up to about $20 million at the end of this period of time. Now, that's unfair because not many people are going to stay all equities all the time. But if they had, with this money, this is what it would have been. And if we look at the two-fund strategy, it ends with 7.1 million. So not a double over the S&P 500 by itself, but pretty close to it. Now, that's the all equity. And to the extent that one was conservative from day one, then they might have picked the 60-40 strategy. It has a lot less risk, 60% equity, 40% fixed income. And while we're on this page, let's see what the bottom line was there. Well, the bottom line was there about 2.85 million versus over 7 million. If we go back to the S&P 500, it is almost 2 million versus the 3.8 million. So there's a huge payoff for people who can actually figure out what is the maximum amount of equity that I would be comfortable. Now, later this year, we're going to be talking about glide paths, where how you, like with a target date fund, where you have maybe no fixed income or bonds in the early years. And by the time you're 40, they start adding bonds. And by the time you're 65, you might have 50% in bonds. There's a glide path. There's this change from all equity to fixed income for a portion of the portfolio. But I want to tell you, there are some big rewards for being more conservative in the bad times. Let's just look at that S&P 500 from 1999. Now, you didn't have 700,000, you had 432,000 if you were 60-40. But by the end of the following decade, you had 566,000. This was the decade that the S&P 500 lost $40,000. So there are times having some fixed income is going to feel really great. Now, I want to take you, and I don't know how you're going to process all of this. We have given you all of these tables that Daryl has built to help you understand the risk and return, that relationship. So how might you figure out what's right for you? Well, it may be those fine-tuning tables we talked about a little while ago. They're going to give you all these losing periods down here, and you're going to say, well, I certainly wouldn't want to ever lose more than 40% of my money or 34% of my money. You're certainly not interested in losing 55% of my money. Or maybe you are. Maybe if you understand that's part of the process of building a successful company. And by the way, Amazon went up to what? At one point, it was over 100 before it went down to 17. And then it took off like a rocket. That's the way many companies act, perform. But here's what I want to show you. Once you get this relationship here with the fine-tuning tables between return and risk, then you can convert that to the implications to this contribution over some 54 years. Because here's what I want you to see. I want you to see at the end of that 54-year period with no equities, $560,000. With 10% equities, 701,000. And by the way, when you go back to that, in fact, I'll do it right now. Go back to that fine-tuning table. You look at the worst 6 or the worst 12 months, they're virtually the same for the all fixed income and 10% in equity. But they're certainly not the same when you look at the money that's left over. And the next 10% brings it up to 872, then a million, then 1,000,003, then 1,000,006. This, in a sense, is what you have to be able to picture in the future, that you're going to take a certain amount of risk and it's going to give you theoretically a certain level of return. When we look here at the C9, you can see that you start with that same 560, but you jump to 744, almost a million, 1,000,003, 1,000,007, 2.2. So certainly, if you don't want much equity in the portfolio, I would like you to think seriously about, would I be willing to accept the higher volatility to maybe end up with 744 or 985 instead of 700 or 872? It's the long-term payoff. Now, you're going to have questions about this. Hopefully, these two tables we've had you look at will give you the ability to look at all 9 of the tables and compare them all the way that you want to compare them. They all have exactly the same amount of money going in. Whatever difference is because of the gains and the losses. And if you have questions, I want you to feel free to email me at paul@paulmerriman.com. I especially like it when you put those questions in the comments section of the video here that will be on YouTube, because then I answer those there, and I can't give you personal advice. So you need to pose it in a way that isn't personal. I'm not an investment advisor. I'm a teacher. But I am willing to answer the questions there because I know lots of people are reading those exchanges. And I want you to be sure and come back for the next video, or if you're a podcast listener, the next podcast, because the next one is going to be on distributions. We got you got yourself to wherever you are in terms of how much money you have at retirement. Now we are going to focus in on taking money out. There are 2 ways I'm going to cover. The first is for next time with fixed distributions, and the one after that will be variable, totally different kinds of ways of taking money out of your investments in retirement. As always, thanks for listening. Give us the share this with somebody, like it so that people know that others have gained something from it. I always enjoy reading your comments about what more that we could have done on this that would have been helpful. We're in the growing stage here, as you know, so we're happy to help. Thanks for watching.